Hey guys, what's up? Welcome back to My Financial Focus. This is part 3 of the balance sheet series that I've been doing, just breaking down and explaining each line item of the balance sheet so we could get a better understanding what it is that we're actually looking at when we read through these financial statements. Where I last left off in part 1 and part 2, I spoke about the assets and the liabilities on the balance sheet. And so for this video, I'm going to end it off by talking about these 3 line items right here and then finishing off with the equity section, which in my opinion is the most interesting part of the balance sheet. So thanks in advance for leaving a like, and let's get right into the video and not waste any time here. So right here we see under total liabilities where I left off last time that it says commitments and contingencies. And what this means on the balance sheet is basically Tesla alluding to the fact that they have commitments, which is basically a promise made by a company, in this case Tesla, to external parties resulting from legal or contractual requirements that they've made in the past. But this doesn't always exactly equate to being a liability or necessarily a commitment to a stockholder, which is why it's placed in the middle here, because it doesn't really classify exactly as equity or as liabilities. It's sort of a hybrid product, and it could be either or. And then right here it says contingencies, and this is pretty self-explanatory. A contingency is basically an obligation by a company, and they're basically just making sure that in the future, if some sort of event or occurrence happens or doesn't happen, that they'll be obligated to deem or complete some sort of performance in the future if that does happen or doesn't happen. And then we see right here it says note 16. Whenever it says notes and then some sort of number following it, or right down here it says like 1, for example, or 1 down here, what that's alluding to is the notes to the financial statements, which can be found a little further in the annual report. And I've gone over those things in my previous parts of the balance sheet series, as well as in the previous financial statement videos if it wasn't in the previous balance sheet parts. So feel free to go check those out if anyone wants some more detailed explanation of the notes to the financial statements. And the next line item we see right here is redeemable non-controlling interests in subsidiaries. And this is basically just when a outside party, in this case a non-controlling interest, has a minority interest or an ownership position of less than 50% of outstanding shares, and they also have no control over the decisions that the company makes, so they have no voting rights. And then, so in this case, because it says redeemable non-controlling interest, these are redeemable at the option of the non-controlling interest holder. And so basically, if anyone owns a minority stake in a subsidiary of Tesla, which is a company that's owned by the parent company, then they can redeem their non-controlling interest at any point in the future, and Tesla would be obligated to allow them to redeem their non-controlling interest, which is equated by this metric right here. And then underneath that, we have one of my favorite debt instruments, which is the Convertible Senior note. And this is basically a debt instrument where it basically has a lower interest rate in exchange for the right to convert the debt into equity later on. So let's say, for instance, Tesla wanted to raise money by borrowing money from an outside party. If they were to borrow money with a regular loan, then they might have to pay pretty high interest rates for that loan, especially if it's some sort of emergency loan or something like that. And so what they might end up offering is a convertible senior note, which basically offers to the lender that in exchange for them offering a lower interest rate on this loan to Tesla, they can then have the right but not the obligation to convert their position or convert this senior note into equity in the company later on, almost like collateral, just in the case of a default or in the case of some sort of future contingency or commitment that Tesla makes to that outside lender. And now we're getting into the equity section, and this is going to be pretty interesting here, especially when we get into par value and these different shares authorized, issued, and outstanding things down here. So right here, equity, what equity really is it represents the shareholder's stake in the company, which is identified right here on the balance sheet. And then right underneath that, we see stockholders' equity. And this is basically just calculated by taking the assets minus all of the liabilities. And it basically just represents the assets that would remain once all of the liabilities have been settled. And so it's pretty similar to, say, an individual person's net worth. We just take all the assets that they own, like their real estate or their stock portfolio, and then we subtract all of the debt that they have, like their student loans or something like that, and then that gives us the net worth of that individual. It's pretty similar with a company. We just take all of the assets that they have, subtract all the liabilities, and that gives us the net worth of the company, or in this case, the stockholders' equity. And this can also be calculated by adding up the common shares, preferred shares, and the retained earnings of a company on a balance sheet. And right underneath that, we see preferred stock, and that's like less than a penny of par value, 100 shares authorized, no shares issued and outstanding. So I'm going to explain what all of that means right now. So preferred stock is basically stock that entitles the holder of preferred stock to a fixed dividend. And preferred stock differs a little bit from common stock in that common stock dividends do not take priority over preferred stock dividends. Preferred stock dividends take priority over common stock dividends. But on top of that, people who own preferred stock don't have any voting rights in the company, so they don't have any controlling decisions in the direction that the company goes. They just get priority for fixed dividend payments. And then on top of that, sometimes preferred stocks can be hybrid instruments. So some sort of contract can be negotiated between the investor and the company to where the preferred stock might include some sort of option or warrant to be exercised in the future or something like that. So they're basically hybrid instruments that are negotiable between the investor and the company, in this case Tesla. And right here we see par value, and this is something that trips up a lot of first-time readers of the balance sheet. And what par value is it's basically an outdated traditional metric that was used a very, very long time ago, like centuries ago, to basically represent the minimum amount that a business would be allowed to issue stock for. And so what that basically means is back then, before people started just creating financial statements that weren't really relevant to par value, they would basically be in a situation where they would say, we're not going to issue stock from this point forward that's anywhere beneath the value of par value. So someone might have issued shares of a company at a par value of $100. That would basically mean that from that point forward, they were not allowed to issue shares of their company for less than $100 per share. But of course, that means that if the company's stock price tanks below $100, then they're not going to be able to issue shares at $100 because nobody's going to want to buy those shares at $100 since they aren't worth $100. But because their par value was $100, they aren't allowed to issue shares of their stock for less than $100. So if they have to raise capital by issuing equity in their company, they aren't able to do so because their par value is too high relative to the share price of their company. And so this was basically put into place in order to protect previous shareholders back then, a couple of centuries ago, because obviously if someone receives shares of a company and it's at $100 per share or something higher, and that company starts issuing shares later on for $50 per share or $20 per share, then the previous shareholders who bought in at $100 are going to be extremely diluted, right? And so this law was basically put into place to protect those existing shareholders. And so in order to avoid this complication, what companies started doing, this is like a history lesson now, but basically what companies started doing is they started setting their par value extremely low so that they could issue stock at any price in the future. And that's why whenever we look at balance sheets for literally almost like 90% of the companies that trade in the stock market today, they always have their par value set extremely low, sometimes even lower than this. I've seen balance sheets where it'll say par value 0.00000005 or something. And what that basically means is they're just setting their par value extremely low so that at any point in the future, if their share price is trading at like 1 penny per share, they can still issue stock at 1 penny per share because their par value is even less than 1 penny per share. So that's basically what par value means. It's just an outdated metric that really doesn't hold much bearing in today's financial system. And there are some companies that have gone as far as to just not even use par value anymore. They just issue stock and they don't even have par value on their balance sheet. They just issue stock at whatever share price they want to issue it at. Then right here we see 100 shares authorized. And shares authorized is basically the amount of shares that the board of directors has said that the company can theoretically issue if they would want to. So a company isn't able to just issue an infinite number of shares if they so please. The board of directors has to first authorize that a specific number of shares can be issued in order to protect shareholders from dilution. And then from there, the company's management can go and issue shares up to that authorized limit in the future if they want to raise capital. Then right here, no shares issued. Shares issued is the amount of shares that have actually been issued to raise capital. And this is, of course, up to the limit of the shares authorized by the board of directors. And then shares outstanding right here, that's basically the amount of shares that have been issued minus the amount of shares that have been bought back, which is otherwise known as the treasury stock account. So sometimes we see companies announce that they're doing stock buybacks. And what that means is of the shares that they have issued, they're going to buy back some more shares, which is going to basically make it so that there are less shares in the market. It's going to increase the share price of each individual share of stock in their company. And so shareholders who are holding on to shares at that point, they're going to experience some sort of profit or appreciation in the price of their shares of the company because of the buyback, which is treasury stock. So shares authorized, board of directors just authorizing a limit on the amount of shares that can be issued. Shares issued is the amount of shares that have been issued to raise capital. And then shares outstanding is the amount of shares issued minus the treasury stock account, which is the amount of stock that the company has bought back. Pretty simple. And then right here we see common stock, and they give us the exact same values here: par value, shares authorized, the amount of shares issued, the amount of shares outstanding as of December 31st, 2020 and 2019 respectively. Common stock is basically when somebody logs into their broker and they buy shares of a company, that would be considered common stock. It's basically just a security that represents ownership in a corporation, in this case Tesla. And holders of common stock are able to elect the board of directors. They're able to vote on corporate policies and on the future decisions or some of the future decisions that the company will make in the future. And theoretically, if the business is ever liquidated, this isn't usually how this works, but theoretically, if the business is ever liquidated, then the percentage of the business that a shareholder owns, almost like a slice of a pizza pie or something like that, that's the amount of the liquidated proceeds that they would theoretically be entitled to if they own common stock. And then we see right here, there's like this number over here that says 1, right? So this is a little bit confusing. People see this, all these numbers, it doesn't make much sense, right? So what this number right here is representing is the par value multiplied by the amount of shares outstanding, basically, I believe. So basically, like I said before, a par value is extremely low. And when a company issues shares, it says right here 960 and 905 shares issued and outstanding. So 960 shares issued, 905 shares outstanding. This basically just means that they're taking the amount of shares that they issued to raise capital and they're multiplying it by the par value. And that's giving them this extremely low number, which is 1, right? And then right down here, we see additional paid in capital. And this right here is the actual amount of capital that they raised by issuing this 905 shares or 960 shares issued. Sometimes with balance sheets, this part can get a little bit confusing. I've seen some companies where the additional paid in capital will represent the shares issued. And then for other companies, it'll represent the shares outstanding. Like I know for Apple, for example, they do stock buybacks quite frequently, which reduces the amount of shares outstanding in their company. But for some reason on their financial statements, sometimes the shares outstanding number doesn't really get impacted, but the retained earnings number gets impacted. So sometimes the way some companies report these financials can get a little bit confusing. But just to keep it simple, this value right here, additional paid in capital, what it basically means is it's the amount of shares that were issued to raise capital multiplied by the actual share price of the company when those shares were issued. And so if we take additional paid in capital plus the amount of money that was raised from issuing stock at par value, that gives us the total amount of capital that was raised from issuing stock in the company. A little bit confusing, but if it was too confusing, feel free to watch that part of the video back a little bit or ask me in the comment section down below. I'd be happy to clear it up. And so right underneath that, we see accumulated other comprehensive income or loss. What this basically is it includes all of the unrealized gains and losses reported in the equity section of this balance sheet. And then, there's a statement that says other comprehensive income in the financial statements, which I might make a video about in the future. But basically, when a company, say, buys shares in another company, and those are basically shares in a company that they haven't sold yet, so they haven't actually realized those gains or losses, those unrealized gains or losses get reported in this line item right here, accumulated other comprehensive income or loss. So this basically just fluctuates based on markets and the different share price movements. And so as of December 31st, 2020, when they took a snapshot of their financial position, this is what the unrealized gains looked like on their balance sheet. And then right here, we see accumulated deficit. This is basically the opposite of retained earnings. In Tesla's case, as of December 31st, 2020, they had up until that point been operating at a loss. And so all of the operating losses that they accumulated over the span of their operating history, this was accumulated in this line item right here, accumulated deficit. And for a company that might have been profitable year over year, all of the profits that they basically retained in the company didn't really reinvest or distribute as dividends. That would get put in this line item right here, except it would be called retained earnings. So it's retained earnings if the overall accumulation of the profits and losses from the operating history of the business is positive. That would be retained earnings. And if the overall accumulation of the profits and the losses from the operating history of a business is negative and they're experiencing an overall loss, that would be considered an accumulated deficit in this line item right here. And then underneath that, we see total stockholders' equity. This basically just takes into account all of these equity items right here added together or netted because we're subtracting the accumulated deficit. And then that gives us the total stockholders' equity account. And then right underneath here, we see non-controlling interest in subsidiaries. This is similar to this line item right here. It's basically just pointing out the amount of ownership interest in a dollar amount that the non-controlling interests have in subsidiaries that are owned by the parent company, in this case, Tesla. And then right here, we see total liabilities and equity. This is taking all of the equity here added to all of the liabilities here, and that gives us the total liabilities and equity, which is equal to the total assets, thus balancing it out. That's why it's called the balance sheet. And then lastly, we see right here, prior period results have been adjusted to reflect the 5-for-1 stock split in August 2020. This basically just is a note letting us know in the financial statements that some of these values might have been adjusted to account for the 5-for-1 stock split. But in the case of the balance sheet, it didn't really have much effect because the 5-for-1 stock split will affect like shares outstanding and things like that. And in the balance sheet, in this case, they don't really have any values that were directly affected or show exactly like how the difference in shares outstanding might have affected some of these accounts. We would see more of that in the income statement or the cash flow statement or the statement of stockholders' equity, which I touched on in the past. And that basically wraps up everything to do with the balance sheet. I tried to be as detailed as possible in these past 3 videos. So if it was helpful, definitely leave a like. It helps out my channel, helps these videos get recommended to more people on YouTube. Subscribe to the channel, and I'll see everyone in the next one.